Naren, we are in that time when there is fear, there is excitement, there is greed, and there is also an opportunity.
I think it's a very difficult time. Global geopolitical environment is extremely disturbing.
Identify the cycles, equities. In this entire map, which is in front of both of us, where should I put this equity?
I would say FIIs seem to be in despondency at this point of time.
The second puck is the most controversial puck, small cap and mid cap. They were in a state of euphoria at the beginning of the year. Your proprietary indicator, which is the indicator which the AMC uses for benchmarking purposes, for the first time it's flashing green after COVID.
The indicator is saying that today the market is not that expensive. Normally the residual asset class is gold, but this time the residual asset class just took off.
Let's look at growth 2030. नरेन के चेहरे पे स्माइल आती है जब दुनिया में दुख होता है.
No, absolutely. I don't want to have any of such reputation.
So if I have to put this block here, which is risk, which could topple everything, what is your definition of a good fund manager? Great fortunes are not built in noise. They are built in the silence of conviction. My guest on the show today has never claimed that he can predict a market top or a market bottom, but he surely understands the alchemy of market cycles, fear, greed, depression, and more importantly, euphoria. S. Naren, in last 3 decades, has fulfilled the most important duty of a fund manager, which is to generate compounding return for investors by keeping risk as the centerpiece and has managed money with a lot of integrity. Today, we'll not only talk about market cycles, we will build them. We'll talk about where India is headed in 2030. And more importantly, in this time when everybody is worried, some are excited, where is opportunity for a long-term investor? Naren, nothing's changed for you, but a lot has changed for me. So thank you for joining us.
The pleasure to talk to you, Nikunj, after quite some time.
Naren, we are in that time when there is fear, there is excitement, there is greed, and there is also an opportunity. Paint the big picture for us.
I think it's a very difficult time in the sense that, the global geopolitical environment is extremely disturbing. So every day we have to watch the global geopolitical development. Over the last decade, the Indian macro has been kept very, very well. So we just used to not worry about macro, only focus on valuation. When it was cheap, be very positive. If it was costly, be worried about valuation. So we have one of the most difficult periods because see, if you are a country and you know that the events are not designed by you and a lot of things happen around you on which you don't have a control, it is a tough time. And as fund managers of other people's money, it's not an easy period. So, we have to we always watch developments 24/7, not knowing what will happen in the next 6 hours. And that has been the period now for almost 45 days now.
You have a reputation. Some call you Mr. Contrarian. Some say you only smile when there is bad news. Some say that you only laugh when there is a panic in the market. That's not a great reputation to have. That नरेन के चेहरे पे स्माइल आती है जब दुनिया में दुख होता है.
No, absolutely. I don't want to have any of such reputation. See, at the end of the day, we manage other people's money. And what we have seen over periods of time is that when everything is good, people forget the word called risk. And then they say we have to make money at any cost, like parts of 2024, parts of 2007, etc. And there are times like 2020 when people forget that there's an opportunity ahead of us. So the challenge, when you're managing other people's money at ICICI is to see how can we try to make it better for the investor. And that is the only way in which the investors will trust the mutual fund industry and us. And that is how we've looked at it over a period of time. So there is no question of being happy if markets fall, never. At the same time, there is no question of being very happy if the market is crazy and that people are doing the wrong things by buying at a point of time.
Naren, so can I say that in last 2 years, the macro was good but the micro was decent. Now the macro is challenging, but the micro is getting better.
Clearly, the micro, see, go back and look at 2009. If people had looked in March to May 2009 and asked, how's the micro? It would have looked very bad. Go and look at what happened after 1 month when the world was closed in COVID and asked, how's the micro? It would have been bad. Micro mean reversion is much easier to believe in. So you know that bad things don't last forever. So actually what happens is, it's not that the micro is going to be very good for the next 3 to 6 months. It is a question that you know that the next 3 to 6 months, lot of companies are going to face increased cost. They're going to have problems in their supply chain, etc. But if you go back 2 years later, if you go forward 2 years later, you know the environment is going to be much better than where we are today. So micro is always easier to predict than macro. And that is why when micro is in favor, it's easier to buy than when macro is in favor. If macro is in favor and micro is not in favor, which means valuations are high, you just don't know what to do.
Naren, you've never claimed that you can call a market top. You never claimed that you can call a market bottom. But you've always insisted that the biggest truism in the market is that markets are cyclical. Greed, fear, excitement, they're always part of the cycle. You're a top-down investor, just to break it for our viewers, that you look at the big picture and then you start allocating capital. And how beautifully ICICI, Prudential, AMC has really managed or compounded wealth for investors over the years, I think is quite extraordinary. But my question to you, Naren, now is that let's identify the cycles. Equities. In this entire map, which is in front of both of us, where should I put this equity puck?
Actually, if you look at it, there are two types of investors in India. One I call FIIs, and second I call the Indian investors, Indian institutional investors. I would say FIIs seem to be in despondency at this point of time. And they have not seen returns for the last 2 years. In dollar terms, they have actually not made money. So they are really despondent about India. As far as domestic institutional investors are concerned, they are in anxiety. But whether that anxiety will go back to thrill or whether it will go to fear, they themselves don't know. But they are right now in a feeling of anxiety. But at the same time, they strongly believe in the India story. They strongly believe that India is a good long-term investment opportunity, which is the reason why mutual fund inflows have been so good. So while they have anxiety, they are not worried about India long-term. So they are more looking to move to the thrill camp than to the fear camp at this point.
But fundamentally speaking, purely based on the cycle, growth and valuations, where do you think in next 3 years, which is a reasonable time frame for any asset class, the puck for equity will move? Will it move from anxiety to thrill, or will it move from anxiety to fear?
I'm of the view that I don't know how to put it in a cycle format. We've been telling people we are in a moderate return world. The reason is that the global geopolitical situation is just so uncertain. Valuations, if you look at a valuation which doesn't incorporate earnings like market cap to GDP of the world, we are close to record. So to expect big returns like what happened between 2020 and 23 is unlikely at this point of time. So you are in a moderate return world. If the despondency of the FII goes to relief and they start putting in money, the returns will be much higher. And if at that point of time the anxiety of the domestic investor converts to thrill, then the returns are going to be very high. On the other hand, if you have a situation where the despondency of the FII continues because of global developments, then you're going to have moderate returns only.
So when you say you think that return expectations from equity as an asset class should be moderate, the long-term equity return is nominal GDP plus 2%. That is the historical return for equities. So next 3 years, according to you, equity as an asset class, will the returns be in line with the long-term averages?
So it could even be nominal GDP rather than nominal GDP plus 2%, because there can be some derating of the market because of the current situation which is there geopolitically. If you go back and look where we are in 2026, where we are in 2020, there has been a significant increase in market cap to GDP. So I'm saying, can there be a small decrease in that? It can be. It's quite possible. So that is where we are at this point of time.
Your proprietary indicator, which is the indicator which the AMC uses for benchmarking purposes, for the first time it's flashing green after COVID. After a gap of almost 4 years, when the panic struck the world in 2020, valuations, this benchmark or this indicator was green. If you believe that macro risks are there, earnings growth is going to be moderate, then why is this indicator flashing green?
The indicator is saying that today the market is not that expensive. So if we use indicators like price to earnings, price to book, market cap to GDP, and government security yields, based on that, but it doesn't put a geopolitical environment of the world into picture. It doesn't look at where is the cycle in other parts of the world. The cycle in other parts of the world are also advanced. So I would say that's the reason we believe in a more moderate return. And we have to try to telling investors you're not going to make money like 2020 to 23 is very depressing, because people want to make, again, investing into this environment, they want to see 25% per annum. It's very tough. It's tough for us to say this, but the reality is we are in a slightly different environment. Profits have been very good in the last 5 years. The entire macro environment has been very good in the last 5 years. So from here to make mega returns by investing even into this correction doesn't look logical at this point of time.
Okay. The second puck is the most controversial puck, small cap and mid cap. They were in a state of euphoria at the beginning of the year. Where are they now?
They are not in euphoria. Clearly, small cap is not in euphoria. I mean, actually, if you look at small cap from the point of view of FIIs, they are in despair. And if you look at locals, they are in anxiety. They are not in a phase of that. Why this happened, I will tell you, is because the domestic corporates and domestic promoters, they issued huge amount of paper. They could see the euphoria in 2024 and said, let's do as many IPOs as possible. So while we all got money, the money got invested in so many IPOs that the entire euphoria disappeared because of new fund, the amount of money collected in the capital markets. And many of the private equity who had invested in the 2018 to 20 phase, they got an opportunity to exit all their holdings to mutual funds and other investors. So what happened was that while the money came, the amount of new money which was raised ensured that the market didn't go up. Mid-cap is slightly different, because what happened in mid-cap is so many companies can't get created. It's a limited set of 150 companies. And in that 150 companies, FIIs were not big sellers. So consequently, mid-caps have not corrected and they continue to be expensive. So that's the situation. Is there a trigger for them to come down? I think if SIPs continue in that area, I think it's tough for the mid-caps to come down. Having said that, are they cheap in our framework? Answer is no.
Okay, debt. You've been making a case that nobody is talking about debt. So where will the debt puck go in this cycle?
Debt on the domestic side is, I would say that they are in despondency or despair, because today if you try to tell people, even after 2 years of no returns in equity, invest in debt, they look at you, whether I'm talking about an asset class in some other planet, and that's how they look at it. And so, the domestic investor is in complete despair. Somehow in the last 5 years, gold gave very good returns. Global investing gave very good returns. Domestic equity investing gave very good returns. Silver gave very good returns. So they are in a state of despair on debt. So it is and as you know, the way Indian debt market is, the foreigners are not given an opportunity to participate in such a big way. So it's from a cycle perspective, it's extremely attractive. Normally, the residual asset class is gold, but this time the residual asset class just took off. So the residual asset class has become debt. So that's why debt has become a very interesting asset class. So to tell people to consider debt or fixed deposit or anything like that is not at all easy.
Can I say silver and gold, or gold and silver, or precious metals, they are still in euphoric stage?
Yes, certainly January was euphoria. Even now it is euphoric, but you have to remember that
I'll
particularly
put it in center then.
we have long argued that silver, for example, is a small cap stock. The entire float of silver is so small that it is not an asset class. Gold is an asset class. So gold is, I would say, an asset class which is an anti-dollar asset class. There are so many people who worry about dollar. Consequently, they go and invest in gold. To argue that one should be in euphoria and gold, I would say more anxiety in gold. I would say silver is more in euphoria and gold is in anxiety, because gold plays a role in a world where people don't trust each other in geopolitics. I think gold is one of the best asset classes, and therefore it argues for some allocation, not zero.
But silver is zero.
Silver is zero because silver can't play a role, or you can't keep tons of silver and say, I'm going to manage silver. That's just impossible.
These are blank bucks. Tell me where there is a lot of despair. Which asset class is in despair right now? Globally.
Clearly, I said debt is in despair.
Okay.
Very clearly, debt is in despair because it's tough to convince people to invest in debt. That is, I would say, the only asset class where I think to convince people to invest is tough.
What is in euphoria in the world?
In euphoria, there are many. I would say silver was in euphoria clearly in January. I would still say that US tech investing is in euphoria, but it never seems to end. We have called for it 1 year back, but nothing has happened. It's become costlier. So people know that those stocks, one was 3 trillion, it's become 5 trillion. So $5 trillion market cap companies get created today. There are going to be 2 IPOs of some artificial intelligence companies. And there is going to be a company, I think, which is going to put people in space, which is going to get listed. So those kind of companies look to be euphoric to me at this point of time. But, while we can talk of euphoria, it has not worked. So have we been wrong? The answer is yes, we have been wrong so far.
IPOs, where do they come in? Are we in this euphoric stage of the market?
I think the euphoric stage of the market is over there.
Even in IPOs?
In IPOs also it is over. Today, if you had to look at an IPO, I would say the kind of difficulty that most of the companies have had in the last 1 month or 2 months to get an IPO done is not easy. The number of IPOs have just fallen off. The number of blocks have fallen off. I don't think we are in that phase of 2024 where a loss-making company could very easily raise money by doing an IPO or a QIP. Today, it is very, very tough. I think that phase, but can it come back? Yes. So I would say it's a very interesting situation. You are possibly even in fear in IPO. But from fear, can we go back to excitement and thrill in your sheet? It's something that can't be ruled out because the domestic investor believes in equity as an asset class very strongly. So if they continue to believe in that asset class very strongly, there is no reason why we can't again have a buoyant IPO market in the next 3-6 months.
Naren, you've always identified these cycles for us, and thank you for identifying these cycles over the years on different forums. I want to understand that what is the science and the maths behind it? I mean, is there an indicator which you look at which tells you that ye peak hai, bottom hai, ye despair hai, euphoria? Is there a mathematical number or this is just gut call?
There are different gurus here. Warren Buffett says, look at how others are investing. So in 2024, we could see people launching IPOs, and those IPOs, they got subscribed so easily without enough of, analysis at that point of time. So that's an indicator. Then you look at how much money is coming into an asset class. The amount of money which is zooming into an asset class. Take, for example, January inflows into gold and silver ETF. It was such a sitter to know that we are at a peak. I mean, never before has gold and silver got inflow equal to equity as an asset class, but it got it in January. So I would say flows are a very, very important part of what you identify top and bottom. Clearly, if you look at March, the reason for the green clearly happened because FIIs sold equity that month in such a big way. So if you just look at the flow parameter of March 2026, it will show as one of the biggest sell-off by FIIs ever. So that is the reason why the indicator came to green, although it's not connected to flows. But the reason on March 30th it came to green is only because of savage FII flow. I would say flows play a very big role, valuation plays a role, and how people around you think about it clearly is a very, very good indicator of where you are. Like, when you do a investor event, if every day, morning, afternoon, evening, if people ask you, what should I not invest in silver? That is an indicator that something is. And if you have to talk about asset classes which are important, like, we've seen periods like 2008 December where people were just not willing to think of equity. Those are all superb times to consider that asset class.
Can I say that while everybody is claiming that AI is going to be changing the way how we would be working, AI actually will never be able to capture the emotion of fear and greed, because ultimately AI models are based on past data, and past data cannot tell you what is happening in the future. So for an average Joe who thinks that, okay, AI is going to change the investing world, the grain of the truth here is that AI is important, it is crucial, but it cannot beat a fund manager.
Can't say that. If you look at the success of Renaissance funds, for example, or today there is some category of funds called CTA funds, which have become bigger and bigger and bigger in the Western world. For example, they don't use conventional valuation techniques. They play some different type of way of investing, but they have been successful. Now, why they have been successful, we do not know. So, which shows that you can never rule out how things will move. But we can say, based on understanding, that if individuals were the decision maker, behavioral finance works. But if individuals subjugate it to machines, whether they will suffer from the same greed and fear problem, we do not know. We will know over the next decade whether machines have the same greed and fear problem or they don't.
Then you've always said that investing is about understanding the past, but also understanding what will change. Investing is about being on the right side of the change. And in markets, we need to focus on not where the puck has moved, but where the puck will move. So let's look at India 2030. That's where the puck is going to move. We are in 2026, 4 years. The biggest criteria for any investor is identify growth. So I'm going to put this block here and let's look at growth 2030. Next 3 to 4 years. Are we in for a lean growth patch? Are we in for a moderate growth patch?
Actually, this is the debate that we at ICICI keep having. The biggest challenge is it depends on how AI will affect India. Now, is AI going to lead to a situation where Indian IT services continues to grow, Indian GCCs continue to grow, or does it lead to a situation where these industries are going to have challenges? That is going to be very, very important. As we speak, we are big believers that over a period of time that Indian IT services will have to re-engineer themselves to grow, but they'll continue to grow once they re-engineer themselves. And GCCs will not get that badly affected because India is a very competitive destination in services. But if there were to be concerns on them, and it's not that as the facts change, we have to change our view. With the current view, we believe that Indian IT services will have to re-engineer and GCCs will at least not degrow. Then things are okay. But if something were to go wrong there, then I think we have a challenge. Because otherwise, if you look at it, India has very good macro. India has working age population, which is growing. I mean, from all those points of view, I would say growth should, we have domestic savings. We don't have a current account deficit. The domestic savings can take care of basic growth. We're not served. Last 2 years, we have hardly got any FDI. Despite that, the growth has been decent. So we don't worry about it. I think this is the only factor, and it's not a factor we know. We are trying to think about it, but we don't have certainty.
There are 3 big changes happening. One is AI, second is energy transition, and the third is the consumer. Let's understand the impact of AI. Everybody feels that it will lead to productivity gain. We will have more time on our hand. We would be spending out a bit more. What to your mind could be the net impact of AI? Will the AI, will the companies who will the creators benefit? Will the adapters benefit, or will the consumer benefit?
History says that almost everyone benefits. So you take the mobile revolution. Do you think it's only the person who made mobile phones who benefited? All of us gained. Take the computer revolution. Do you think it is only the people who made computers who benefited? Everyone gained. So if you go by the past technologies, everyone has gained. There is a point of time, when if you look at the past boom, it was only the PC manufacturer who benefited. It was only later we discovered that the PC manufacturer can help us. So if you look at the entire internet boom, who would have thought we'll create such a beautiful payment mechanism like UPI? It happened because of internet systems. So I would say that at this point of time, we are finding it difficult to see how it will move forward. And I wish we had foresight, but we don't have that level of foresight. What we do is we keep thinking openly and be willing to change our views. But I think many companies will also have to change based on evolving things. And many individuals also have to continuously keep learning to update themselves on changes in technology. And that is the challenge ahead of us.
The second block for any investor is earnings. For next 3 to 4 years, at the aggregate level, how do you see the earnings trajectory moving? Is the worst of the contraction what we saw 12 months ago, 18 months ago, where the earning estimates were downgraded, base effect had kicked in, consumer had slowed down? Is that lean patch behind us?
See, this 2020 to 23 kind of period where earnings grew substantially, that phase won't come to the same extent. Simply because at that point of time, at the starting point, there were areas like financial services where profits were very low. So those profits grew significantly in that period. So we are believers that maybe the earnings slowdown goes away and earnings improves. And clearly there will be possibly better earnings. 2027-28 over 26-27 should be good, because 26-27 will have all the problems of the after effect of what's going on at this point of time. So we are believers that 27-28 should be much better than 26-27. And that can help the earnings as such. But to expect that earnings will drastically change like 2020 to 23 period, we are not believers. That's the reason we are much believers in a more moderate return environment. And that is the main reason, because we don't think that earnings in many companies can just shoot up, because the base is much better. We have one corporate profit to GDP ratio. We have looked at the corporate profit to GDP ratio. From 2010 to 2020, it almost came down. From 2020 to 24, it has just shot up. So from here, for it to drastically move ahead of GDP is very difficult.
So Naren, now earning has a couple of components. One, you see a cyclical recovery in some beaten down sectors. You see a big new growth sector getting added, or you see massive capex by the existing companies which lead to a new level of dimension. So divide the earnings picture for us. Are we in for a cyclical recovery from beaten down sectors, or are we in for new growth sectors getting added to the kitty?
I think the new growth sectors will get added much later, like the PC world or even the mobile phone period or even internet. Initially, the profits come in US. And the profits are first seen in US companies. Then after that, when the technology gets exported to the rest of the world and the rest of the world adapts, that time the earnings come in the rest of the world. So somehow our view is that maybe after the first 2-3 years, earnings growth could come in many of these new areas in India. But initially, most of the growth is going to first come in the US tech companies, which is what the earnings, the market caps of those companies are also showing up. As far as cyclical recovery is concerned, cyclical recovery is, as I said, will not be of the stage of 2020 to 23. Some amount of cyclical recovery is possible, but not large, because there are not too many sectors which are actually going through a big earnings problem at this point of time. So that is why for all the sectors to see big earnings growth, we are not big believers.
But then you know this more than, you know it better than anyone else, that the composition of earning at a macro level, it keeps on changing. There was a time when Indian basket was largely a commodity and a textile basket. Then soon it became the TMT basket. Then comes financials, which account for heart of the market right now. So where do you think the large heart of the earnings pool will still lie?
I think India is a leader in services. India, therefore, will see everything to do with services will be the area where earnings will be there. So that will include financial services. It would include IT services. It would look at other services. Then whichever are the areas based on these service sectors where there is a lot of consumption, I think those earnings clearly, if you see sectors like pharma, FMCG, all of them have to grow. Retailing, for example, is sitting on very low profits. Those are all areas where profits can grow at this point of time. But at this point of time, I would say it's tough to predict which are going to, but India is still a services driven economy. But if we take a 5-year view, it's possible manufacturing may take off. Because it is quite possible that India will use this current environment to set up manufacturing bases, because people trust India more than most other countries. So they may actually focus on manufacturing from India rather than trust many other countries.
Naren, you've never been a big votary of chasing what are called as the narrative stocks. A lot of narrative stocks are there in the market. EV, solar, exciting things which are happening in some of the new tech companies. Which is one earnings narrative in the market, do you think, where markets are completely mispricing earnings growth and we are in for a root shock?
I don't know. There was a time when we used to be these electronic manufacturing companies used to trade at 200 P. But if you see the last 1.5 years, some of them have corrected. So I think some of these contract manufacturing areas, if you ask me, have been areas where we have been careful. And because we don't know whether those companies are just going to be supporting manufacturers, whether those supporting manufacturer companies deserve that such high valuations has been a source of, we have not believed in them.
There is a lot of excitement about defense, and looking at the geopolitical crisis, the fact that self-dependability on defense seems to be increasing. While the macro theme is strong, this is a 4-year-old theme. Stocks are not cheap. Even though they are B2G businesses, they're trading at valuations of consumer. Do you see we could be in for a nasty surprise in defense?
Unlikely, given the geopolitical environment. I would say that it's very tough for any country to say we will not invest in defense. Given the valuation-oriented contrarian mindset, within our company, I have found it difficult, but some of my colleagues have found it easier to look at some of the defense stocks because the valuations are much higher than what they used to be. But in this environment, how would you economize on defense? Defense is something very basic, if you ask me, as a country. You can't afford to say, I won't spend on defense.
So, roti, kapada, makan, telephone or defense? I can say that for everybody now. Naren, 12 years ago, you indicated the same to me on a different forum, which is that everybody thinks that India will have only roads and nobody will buy cars. 10 years ago, you told me that everybody is thinking that Indians will only buy cars and there will be no roads. So, wo gaadi aur road ki kahani abhi kahan par hai?
I think we need to create big export industries to take care of our imports of various things. So I would say if we had to take one theme, I would say that we have to bet on exports as a theme.
Which is down 34% already.
Which is down. And we believe that as we need to keep importing oil and various other things, we need to focus on exports as a theme, whether it is manufacturing and services. And I think we have the manpower for it, we have the capability for it, and it is going to take time to build. But I would say if we had to choose one theme, it would be exports.
I'll put in the biggest bugbear. We've not complained about inflation a lot actually in last 10 years. This used to be like this hot topic for every macro investor that inflation ko dekho. Inflation by and large, barring 2022, has been under control. Next 3 to 5 years, will this ghost of inflation haunt us back because geopolitical crisis, supply dynamics, oil, Strait of Hormuz, disruptions are happening? Are we in for a shock on inflation?
I think the Reserve Bank and the government played a very big role in bringing down inflation. That is the reason that India is one of the few countries in the world where in the last 10 years, the government securities yield has gone down, unlike most other countries in the world. So as long as the government and the Reserve Bank continue to focus on keeping inflation under control, we are not going to have an inflation problem. This did not happen just like that. It was due to continuous work by the Reserve Bank and the central government in trying to keep inflation under check. That is something, it is not something which happened just like that. If you look at the last 10 years, show me a country whose government securities yield is lower than what it is. I think Japan is much higher, US is much higher, even Germany kind of countries is much higher. So I would say it is a good, and that effort has to continue. It is a continuous effort. Otherwise, inflation will show up.
I'm saving the most important one for the last, which is flows. And again, we'll have to spend some time trying to understand flows. I'll start with SIPs. The real success story for India. Indians are genuinely now looking at creating wealth by the SIP route. But Naren, while the SIP number has gone from 5,000 to 25,000 crore, are we reaching that high watermark where it will settle in and around 26,000 crore for a long time?
Such numbers we can't predict. But I can tell you that
2030,
it's a habit. It's a habit. And it's a positive habit. So the only thing we keep telling people is don't go and say when gold or silver does well, start a SIP in gold and silver. See, the best asset class to start any SIP is an asset class which becomes volatile and is not trading at the most expensive price. Like today, equity. So I would say this is the best time to start SIP. Whether we succeed or not, this is possibly the best time to start SIP. What is required for SIP to make money? You need volatility. You need not a very high valuation. And you should have confidence that in a 5 to 10 year period, the markets will go up. So that is a situation at this point of time today. So this is the best time to start SIP. So I'm a believer that SIP should go up from here. And I hope people don't start SIP in the asset class which has done too well.
But Naren, for the first time, the real temperament of a SIP investor has got tested. We had a brief lull in 2022 in and around the Russia-Ukraine war, but that lasted for a couple of, I won't say even months, couple of days. This time the pain has been rather prolonged. First last year, no returns, and now absolute drop. When you speak to your distributors, when you speak to individual investors, are you getting a sense of nervousness or the SIP story is intact and formidable?
There is no anxiety. There is no anxiety. There is still optimism on SIP. If I look at your chart, there is no anxiety and there doesn't seem to be any worry on that. People are optimistic on SIP. Many of them are looking and thinking, should I add to the SIPs? That is what they are all thinking at this point of time.
And that's like a, it's like a moment that you want to say, okay, I'm so happy this SIP culture has worked out, because your comments at this juncture, they really matter. Just when, we start getting this uneasy feeling at the bottom of a pit that 3 saal ka return 0 hai, 2 saal ka return 0 hai, you feel there is enough and more awareness which is there that the SIP culture in India is not only intact, it is only going to go bigger and bigger.
Yeah, that's what it looks to me at this point of time. Right now, I would say still an optimism, actually. Let's see. Let's hope we are right.
Naren, we've been used to getting FII flows on a daily basis. Last 24 months, we've been used to getting FII outflows on a daily basis. India in dollar terms in last 5 years has given absolutely no returns. And just like you're thinking that it's time to buy fear, I'm sure from a foreign investor perspective, earnings recovery are decent, valuations are not that stretched. We really are on the right side of a lot of reforms which have happened. Are we in for a surprise that suddenly one moment, just like money went to China, 6, 8 months, maybe 12 months, flows could come back to India?
That's what I mentioned. At some point of time, this despondency should get converted to relief.
It will get relief? Is that a cycle?
It will move to relief. When it will move, I wish I could tell you. But at some point of time, it will move to relief, because India is a non-AI based growth story. And therefore, at some point of time, people will think, have I over-invested in only AI stories? So when that happens, this despondency will move to relief. The question is, people are asking when. That answer we don't have. And the war certainly played a role in again creating confusion. So, but I would say that at any point of time, this despondency can go to relief, but when, we don't know.
I'm keeping the last block, and that can overarch everything what we've discussed right now. There are geopolitical crises we don't know. There are crises which we don't know, but there are some known risk also. So if I have to put this block here, which is risk, which could topple everything, what to your mind is a risk which is a known risk and markets ignoring it?
Not a known risk. I think right now, if you ask me, the market over the last 3 months, see, we have gone through a fair amount of risk. When have you seen oil go up 40%? So I would say the market has not, market has seen one of the largest rallies in oil ever, and oil is our principal input. So I would say that the risk of such an event has actually played out in the month of March. So we had a fair amount of position fall in the market due to that. So the only thing is, do we understand what will artificial intelligence do? That part I would say is something which we worry about, because I think it's a risk which exists in our mind because we don't know enough. What is going to be every day somebody comes up saying one new model is coming up, this new model will do all these things. So do we know enough? The answer is no. Aside from geopolitics, I would say that the impact of artificial intelligence on various things is not very clear to us, and that's a bit worrying.
Howard Marks speaks about, look at the second derivative impact of any new thing, which is mobile phone led to creation of Uber economy. GPS led to the decay of the map industry. Internet created e-commerce. What to your mind could be the second derivative impact or opportunity of AI in India and world in general?
See, when COVID happened, people realized a lot of the work could be done offshore, what was not being done offshore. Like that, after AI, could it happen that more work can be done offshore than even what was done pre-AI? I don't know. That is the wishful thinking that we wish we should have in this country. Who would have believed pre-COVID that we can do so many things away from the place of work? It was just not possible. So I would say that is the biggest positive, that maybe a lot of things can be done out of India, because as a society we have a lot of capabilities. So maybe certain things we can now do which we could not do earlier.
Naren, purely as an investor, I'm committed to invest in equities. I'm personally a long-term believer in the India story. But when it comes to choosing a mutual fund or a fund manager, the options are plethora. What is your definition of a good fund manager?
See, it's a tough question to answer, but I would say that, you have to see people invest on the basis of 1 year return, and people look at return at the top of the market. I would say, I used to tell people, I've done this in an event in Chennai about 18 months back. I said, don't look at any Chinese fund manager at that point of time. I said, maybe the best performing Chinese fund manager may be at bottom. So I tell people, don't look at the performance of a fund manager at an extreme bottom and an extreme top. Second, look at it over a longer period of time. And that is the two things which I tell people. So the process of measurement cannot happen when the markets are irrational. That is the most important. You have to believe that the markets are rational. Now, when do you think the markets are rational? When times like today are rational in the sense that returns have been average. But if return is very negative, that is not the time to measure people.
When I started learning investing, we all were introduced to Benjamin Graham, Intelligent Investor. I've read it once, but I'm sure you must have read it a couple of times. Then we started reading about Buffett, who changed Benjamin Graham's philosophy of cigar butt investing. Then came Renaissance. Investing has changed. Style has changed. What to your mind could change in the world of investing in the next 5 years? Could it be tech? Could it be something different? Like investing has changed. Big money has been made by buying companies which are loss-making. Who would have thought that cash flows would be ignored? What to your mind could change in the next 5 years?
As it is, a lot has changed. Even today, we are grappling on what to do with all the companies which are loss-making and which say that they are all platform companies and they are going to make money in the next 5 years. Forget what is changed. I think the last 3 to 5 years with all these new age companies coming to India has already put us into enough change, and we are yet grappling with it. See, we could move out of the Benjamin Graham model to the Charlie Munger model of looking at quality. Now we have to look at the model of looking into models like platform companies and make successful investing. I think that phase is we are still in that process of learning. Forget the next change. The next change will be AI driven. That is clear. But that stage is first, this stage we'll complete, then we'll go to the next stage.
Last but one question. We all love to talk about change. Kya badalne wala hai, right? I mean, we all ponder over it. Then let's look at what that new thing is going to happen. But Bezos said something very interesting. He said that while we are obsessed with focusing on what will change, I like to identify what will not change. Let's talk about what will not change in investing.
People will focus on performance. They will not focus on risk all the time. At the top of the market, they'll just focus on performance. At the bottom of the market, they may just focus on risk. This doesn't look like changing at this point of time. Everyone knows they have to do asset allocation. But in January 2026, at the peak of gold and silver, they invested so much of money in gold and silver. So what won't change is, at this point of time, if individuals are decision makers, tough for them to handle the greed and fear even today. After knowing that they have to be greedy at the bottom and fearful at the top, they end up doing the reverse.
Naren, you're managing over 10 lakh crore. Well, we've spoken about Buffett, Montier, we've spoken about Harvard Marx, we put in Bezos, we spoke about Munger. But I want to understand your model. If a model has to be made on S. Naren's model, what is your model? Where are you thinking differently? Because I'm very confident of this, Naren, that the coming generation will be reading about the good work, what you've done individually and what this institution has done. So what is your model? I want to understand.
I think, the power of ICICI was that we could collect money, and then we had to create the model into scalable things. We can launch one small sector fund and try to make that the very critical, deliver huge returns in a year, but it won't be scalable. The beauty of ICICI is the ability to actually create scale and then manage scale. Because if your goal is to manage a small amount of money, that is not the goal of ICICI. The goal of ICICI is to create impact on society. That is what they have done from 1955. And I would say that is what is the goal of ICICI, to be able to manage scale in a manner which is reasonable. Because if you're managing very small sum of money, certain things are easy. But we have to do it at huge scale. And therefore, there are difficulties out of it. To manage money at scale in a nice manner, not in a great manner, in a nice manner. That is the goal of ICICI. And that is the goal for which everyone in our company works for.
Then you've done something today which nobody does. A very honest indication to everybody that how they should be focusing on financial planning. While a lot has changed, and a lot has changed for me personally, but for you, I can say I've known you for over 25 years now, nothing has changed. You always keep risk and integrity at the center. Your idea of understanding the cycles and really the way you communicate to your investors is quite incredible. It's an honor to know that I've known you for so many years, and thank you for really ensuring that crores of Indians are really living their dreams when it comes to a secure financial future. Thank you very much.
Same from my side. It has been a great time knowing you for 25 years.
Thank you very much.